Alan, Darby, Jacqueline, Martinez. This is the Buyer's Boardroom. Learn the most about who you are today and where you want to be after.
All right. Welcome back to the Buyer's Boardroom. How's it going, Alan? Kicking off
It's
the
going
year?
awesome. Yeah, 2025 is exciting. 2024 was a phenomenal, probably one of the busiest years of my life. I had a couple weeks off to end the year, so rested and relaxed, ready to tackle 2025. It's going to be awesome.
Yeah, same. Me too. I know. Good to relax. We went out to Palm Springs for a few days, 75 and sunny. Can't beat it. Yeah. Well, perfect. Well, I thought what better topic to kick off the new year than valuations? Everyone loves to talk about that. So
Yeah, I can't tell you how many presentations I've given or been on stage, and I think I'm going to deliver some awesome, in-depth, introspective commentary on another topic, and get to Q&A and ask the audience for questions. And the very first question is, what are multiples today, or some valuation topic? So we definitely know it's on everyone's mind, and thought it'd be an awesome topic to tackle in our first episode of 2025.
absolutely. It should be good. And we can get through just deal math, how deals are structured, things that the sellers control in the valuation, things that the buyers want and don't want when they're looking at your business, what makes it more risky or less attractive. Uh, yeah, should be
Yeah,
good.
we will cover multiples, but we think there's a whole lot of things that the listeners should probably pay attention to that are actually more important, in our view anyway, than the multiple itself. And so it's a meaty topic. Get out your notepads and be ready to take down hopefully some really good information for you. So let's who's going to
Perfect.
be my guest today, Jacqueline? I know
Yeah.
we've so this is our, I don't know if it's our first non-buyer guest. I think we actually had Stephanie Bogan on before as
Oh,
an
yeah,
IT.
true.
Well, but yeah,
Yeah.
but we're, for this topic, we thought it would be great to not have a buyer actually as the guest speaker, but to actually go to an outside firm that we are very familiar with and have worked with in the past to give their professional opinion. Who do we have today?
Perfect. Yeah, we have Mercer Capital. So they're one of the largest independent business valuation transaction advisory firms. We have Brooks Hamner on from Mercer Capital, and he really focuses on all valuation transaction work in the wealth management space, investment management, asset management, all of the different lines through there, including private equity work and other sponsors as well. So super active right in our wealth management space. So it should be perfect.
No, I'm super excited for the interview that you're going to do with Brooks. Usually I do the interviews, but since he's a close colleague of yours, I thought it'd be great for you to do the interview. So super excited about that. Anything cool or interesting happened this in the last few weeks in the year?
Last few weeks. Timely with our topic today, but just been thinking about our intro calls lately, and I would love to find out who's spreading this rumor about valuations being on AUM, some multiple or percentage of AUM, and it's just ridiculous. I think we'll get into how deals are structured, but it's not on AUM. So
Yeah.
if you hear,
Well, I hear that a lot too when people ask me, what sort of multiple can I expect? And then they'll tell me how much assets that they have under management, and I'll have to tell them, well, that really has no bearing on valuation because of the obvious issue of not using AUM is you have no idea what the fee is being charged on the AUM. I can show you a firm that has $1 billion of assets under management and they're generating 10 million in revenue, and I can show you another firm with $1 billion that's generating 5. And so those would two obviously be very different in terms of their valuation. So so what is the valuation math, Jacqueline? So I know there is a general formula that virtually all buyers use.
yeah.
They tweak the basic formula to a degree, but there is a flow that we basically can explain pretty quickly. I can tell you what it's not. It's not a multiple of gross revenue. We really don't see that. Is that an accurate?
Yeah. Very rarely the valuation may be expressed as that, maybe in a smaller business, there isn't a lot of infrastructure, that sort of thing. It's possible, but at the end of the day, the buyer is looking at the EBITDA that the business will generate. Buyers are buying cash flow at the end of the day. So that number needs to be nailed down, and that's what the multiple will be applied to. So an EBITDA multiple, not revenue, not AUM. Yeah.
Yeah, I think that's a fair point because we do see the valuations expressed as a revenue multiple, but that's not how it was calculated. It's merely kind of like a rule of thumb, ballpark type estimate where they throw out a revenue-based valuation, but it wasn't calculated that way. They just kind of backed into it after they derived their valuation based on EBITDA. So that begs the question: what is EBITDA? Earnings before income taxes, depreciation, and amortization. How do you get to that? It's essentially the net income of the business. So when we describe basic valuation math, we start with revenue. Okay. And so what is your revenue? And fundamentally, there's two sources of revenue: recurring revenue and non-recurring revenue. So the first thing that we need to understand in the math formula is what is your revenue, and then what is the mix of revenue, recurring versus non-recurring. So what would be examples of recurring revenue?
So recurring revenue, ideally the advisory fees, the investment management fees, that those are north of 90% of the total. I think anything less than that will really drive which buyers will be interested in the business.
Yeah. So you're bringing out an interesting point there is like if you have non-recurring revenue. So non-recurring revenue would be typically things like commission revenue, one-time commission revenue. So things like you get
Yeah.
insurance product that had a one-time commission, or a brokerage product that had a one-time commission. Um, that it's okay to have that mix in your business, but you mentioned buyers really want to see that less than 10% on average. If you're north of 10%, I think a buyer in today's world, certainly the ones we work with, would start to question philosophically, are you aligned with them? Because they're really uh, committed to the fiduciary standard. They want to deliver objective, conflict-free advice to their clients, and that can be expressed really easily. You can be viewed in your revenue mix. So if you're coming to the table saying that we are committed to the fiduciary standard, all the rest, and we're objective, giving conflict-free advice, but 50% or more of your revenue is one-time commission transactional business, probably going to be in something that gets looked at. And we're going to talk about what are the red flags in the business. But for this calculation, recurring revenue, as you stated, would certainly be your assets under management, your fees from assets under management. It could be recurring revenue from commission products. So if you have, well, if you want trails, things like that, that could also be recurring. Recurring revenue often is any like financial planning fees that you have contractual contracts with clients to deliver just basic financial planning advice. All of those things would be recurring revenue. So let's take a number so we can work through this math calculation. And let's say we have $1 million in recurring revenue. Say there's no non-recurring revenue. The next thing that we need to understand is what are the operating expenses of the business. And in this example, our definition, and correct me if I'm wrong, but our definition of operating expenses would essentially be all costs associated with the business, with the exception of the owners.
Right.
So
Their
we're gonna
compensation. Yeah.
so you're gonna back out any owner's comp, perks, any distributions, anything that's going to the owners is gonna come out of this operating expense line item. And so what are we left with? We're left with staff, vendor rent, yep, vendor costs, technology, uh, custodial fees, all the basic things that you have to pay for to support the business. So we have gross revenue, and let's say it's $1 million. What would you say, Jacqueline, is an average healthy, what we would consider normal in terms of operating expenses on $1 million revenue business?
I'd say about call it 30%, 25 to 30%. What do you think?
Yeah, I would say 25, maybe as much as 40%. but somewhere in that ballpark. So anywhere between 250,000 to 400,000 of operating expenses would be associated with the support of that business. And again, we're removing the owners from that compensation. So
Right.
that's the second thing that you need to be aware of is what is the operating expenses. So let's say we have $1 million in revenue, and we'll go down the middle and say 300,000 of operating expenses. That leaves us with $700,000 of gross profits. What do we call that, Jacqueline, in gross profits?
EBOC, earnings before owner's comp.
Earnings before owner's compensation. So that's the first M&A jargon that we'll throw into this is gross revenue minus operating expenses equals EBOC, or earnings before owner's compensation, essentially the gross profits of the business that would be available to distribute to the owners of the practice. Okay, so if that's the basic existing P&L, let's now talk about what levers that the owner has that they control in the valuation process. And the first one we already talked about, that's the revenue mix. So I would tell a business owner that if your non-recurring revenue, let's say you put it at 90-10, I would say it really gets scrutinized if it's a north of 15 or 20%. So if your non-recurring revenue mix is greater than 20%, I would say you probably want to work on that to try to get that recurring revenue mix, that recurring portion up 80% or better. So even at 20%, we're likely going to see a large number of buyers say, we're not interested in that business because it's not philosophically aligned with our recurring revenue theme. But that would be the first lever you control is what is your revenue mix. The next lever is the operating expenses. So we already identified, call it 30% or 300,000 is the operating expenses associated with this $1 million scenario we have here. Typically, we see a number of adjustments made to the P&L as you go through this process, correct?
Right.
So that's the second lever. The reality is there's going to be some expense adjustments from your existing P&L to the buyers. So what would some of those things look like?
Some of those, I mean, the ones that definitely come off that aren't controversial would be anything that's related to the owners, like maybe their cars are running through, or certain travel, things that you can expense differently as part of, perks that are just different as part of a smaller business versus, as part of a larger organization. Those types of things would end. But then, beyond that, as an independent business as well, you're paying for accounting work to be done. You have your own legal. There's just a lot of things that would be centralized in the new world that you wouldn't be maintaining anymore. So a lot of those can come off, but things that will stay, of course, and maybe even be added to during the valuation process, depending on how your vendors are set up. Anything related to portfolio accounting, financial planning, anything to run the business, all of that has to stay. You need all of that post-close. And if you're really under investing in any of those areas too, I think, being prepared that a buyer may want to add to that so that the business can grow efficiently as well.
Yeah. So we call this the adjustment or the recast of the P&L. Basically, you're just going line item by line item in the expense column of the P&L and trying to identify what can go. Obviously, it's to your benefit as a seller if you can reduce operating expenses that would flow through to EBOC and then ultimately EBITDA, as we'll cover. But there are things that are redundant. There may be staff changes that you want to make as a result of the transaction. As you mentioned, the buyer actually may want to allocate certain costs into the P&L, but there's just going to be this line item by line item adjustment, removing some things, adjusting the cost of certain things, maybe removing expenses or adding expenses rather to the P&L to come up with this adjusted P&L. So that's the second thing that you really control in this process. To a degree, there are things that you're going to recommend removing. For example, the buyer is going to control a bit of what they're going to allocate, if anything, into the P&L. But in this scenario where we have $1 million of revenue and 300,000 is existing P&L, it wouldn't be out of the ordinary that operating expense line, there may be some savings. So that 300,000 may drop to 275 or 250. In certain cases with the buyer, it may go up. They may say, hey, you're understaffed, or we don't see enough marketing expense being deployed into your P&L. And so they may want to allocate. So, this P&L adjustment, or what we call a recast of the P&L, is the second thing that you would control in the process. So let's go to the side of the seller here and say we knocked out $50,000 of expenses in the P&L. So the same revenue, $1 million of revenue, but now expenses have dropped from 300,000 to 250. So the net effect is EBOC went from 700,000 in the current P&L to 750. So we've seen an increase in gross profits just through going through this recast. Doesn't happen every time, but that certainly happens frequently. Okay, so that's the second lever, is operating expense adjustments. The third lever is what is called retained owner's compensation. Okay, so give me, what is retained owner's compensation, Jacqueline?
So this would be the amount that, in most deals that we work on, the owners are not exiting the business through the transaction. They're staying on for a period of time. So it's the amount that they would be paid ongoing in the as part of, the ongoing in the new world, if you will. And I was thinking about too how often we hear that the seller says, I don't need to be paid anymore. Let's just base the valuation on EBOC. I'll have my valuation. I don't need to be paid anymore. And that's always a fun one to unpack as well.
Well, the basic reality is two things, and you're spot on. In 95% of the transactions we're involved in, or even higher, I would say the seller is not looking to exit in the immediate sense, so they're going to stay on board. So there's the reality that they need to meet their living expenses, so they're going to retain a portion of that EBOC to meet their basic living needs. And then the second thing to take into consideration is the buyer needs to make sure that there's enough held in the P&L by the owners to service their clients or whatever role they're fulfilling in the organization in the event something catastrophic happened. If they acquired the business and God forbid the owner, let's say it's one owner in this $1 million practice we have a scenario on, got hit by the bus. Well, they have to go rehire that another person to step in and not only service the clients, but lead the business. And so that is what the buyer is concerned about, is making sure that we're holding enough in the P&L in a market fashion, meaning like it has to be applicable to your local market. It's more expensive, for example, to hire an advisor in Manhattan than it might be in Fargo, North Dakota. And no offense to any market there, but that's just the reality. Some markets command higher amounts for base salary and comp. So this is a negotiating point between the buyer and the seller. And to your point, sometimes sellers, if they've eaten their own cooking over the years as a financial advisor, they've accumulated a nice net worth, and they're saying, I don't need any cash flow from this business. Well, that may be true, but the buyer needs you to retain cash flow in the event something bad happened and they need to go hire your replacement. So this is the third lever in the process, is what is the requirement for owner's compensation to be held in the P&L. So there's a bit of it is, what do you need to meet your living expenses? And then there's the buyer's viewpoint. What do we need to hold in a market replacement scenario? And so what would you say on average in this $1 million scenario that the buyers are seeking in a minimum? Now, this doesn't have to be what the seller needs. If the seller needs more than this, buyer's perfectly okay to have them retain as much as they need. But what would you say on average do you see buyers sort of try to hold the line on in terms of replacement costs?
I would say usually comes in around 25% of revenue, is where we land.
Yeah, I would say that's a really good estimate. Somewhere either 25% of gross revenue, if you want to use a rule of thumb, or 250,000 as a minimum, I would say is also happens to be that we're using $1 million of revenue. So 25% is spot on, $250,000. Just know that this is a negotiating point between you and the buyer. But it's not going to be zero. They're not going to let you hold zero in that column for replacement costs. It's going to be some dollar figure that represents what they would have to spend if they were going to hire a new advisor to step in your role. Okay, so we had 750,000 in our recasted EBOC number.
Right.
So 750 of EBOC, or gross profits. minus 250 of retained owner's compensation, if that is indeed the number, that leaves $500,000 of net income. What do they also call that?
EBITDA. So
Yeah.
thinking about a 50% EBITDA margin, I would say that's the upper end of what would be considered a healthy EBITDA range, kind of like that 30 to 50% would be the healthy range. And anything higher than that starts to question if we have enough resources.
Yeah,
Yeah.
great point that you make here. So in our scenario with our recast, we've landed on $500,000 of EBITDA, and as you point out, on $1 million, that would be 50% EBITDA margin. So that begs the question: what is a normal EBITDA margin, if there is such a thing as normal? And this is a really important point for a seller to know. Often we get sellers that come through our process, highly profitable businesses. They're running at like 80%, 70% EBITDA margins, and they're quite proud of that. And sometimes we have to be the bearer of bad news that's actually a problem for a lot of buyers. And the reason being is that if you look at most of the buyers, and we're talking about, 10 billion, 50 billion, 100 billion type firms, what's their EBITDA margins look like? I would say on average, they're probably around 30, 35% EBITDA margins. Um, and they're investing in their business, right? They're investing to continue grow, build infrastructure, invest in tech, organic growth, all of these things. And so when they see that ultra high margin business come along, it raises some major red flags for them. Why is that, would you say?
I think, I mean, when you think about the risk of the business, it's possible at that point then that it's very reliant on a few, maybe even one select person that's client facing. And there may be a lack of like Gen 2 leadership on the team that could take over the business that just not really set up to be a success for the next 5-10 years.
Exactly. And another term that's used in the industry is a lifestyle business. These, and nothing wrong with a lifestyle business. We're not throwing rocks at you guys out there who are running those ultra high margin practices. But what Jacqueline is saying is absolutely right. Normally, when we see those 70, 80, even maybe a 60% operating margin business, they don't have Gen 2 in place. It is totally reliant on the founder or founders. They run in a very skinny operating expense. They're doing everything, so they're doing compliance and they're doing tech management, they're doing people management, though they can't go on vacation without having their phone attached to their ear the whole time. Now they're making a lot of money percentage wise on their business, but they haven't really invested back in the business to build that support infrastructure such that if something happened to them, the business could continue operating. Okay. And so I would say like a standard healthy EBITDA margin number would be somewhere between 40 to 55%. You know, uh, would you like
Yeah.
something maybe as high as 60? But when you start to get like to your point, when you start getting above 50% EBITDA margins, maybe it won't be a problem for the buyer, but it will start to raise questions. They're going to want to know, is this business sustainable? Does it have people in place such that if something happens to the owner, are we going to have to parachute in there with personnel and spend money to keep the business going?
Yeah.
So once you're up at that 50%, as you mentioned, you're hitting that upper range of where they're going to start scrutinizing it, and feeling comfortable. So just know that doesn't mean we've done many transactions where the margin was much higher than 60%. But just be prepared that the buyer might come in and say, hey, we may want to allocate a staff position or two to support the current business and hopefully growth going forward. Because to many buyers, when you're running that high of an EBITDA margin, you're probably not growing that.
I was just gonna say that, like, yeah, it's usually correlated with low growth. I mean, industry wide in RA businesses, the average is low single digits, 2-3% they're quoting, but often at those margin levels, it's totally flat once you remove the market change that's been happening through the year.
Yeah. Yeah. We just did one. In fact, it was a sizable business and they had really phenomenal growth historically. But if you look at their previous 5 years, they really flattened out and they were operating around 75% profit margins. And they were very quick to tell us as they came through the process, we haven't been able to hire staff. We've struggled, finding the right people. And it was reflective in, one, their profitability was through the roof, but two, their quality of life, they were getting burnt out and they were looking for operational relief. And that was a strong motivator for their seeking a partnership. Okay. Well, now we've got $500,000 of EBITDA. But there's going to be a multiple applied to that. We're going to get the multiples in a minute, I promise. But so let's just say there is a valuation derived from that $500,000 of EBITDA. What's the next big decision that the seller is going to be faced with in this scenario?
The next big decision is going to be the mix between how much cash versus equity they want to receive in the transaction. And some buyers don't offer equity, but if that's important, then that would filter which buyers would really, be a fit for that seller.
Yeah, yeah, we call this the currency stack. And there's broadly speaking, there's two forms of currency, cash and equity, but I'll throw a third one in there, deferred cash. Um, and deferred cash is just cash paid over time. And so it's a major point that you need to be considering as a seller coming into the transaction before we even get to the valuation and all the rest is, are you open to rolling a portion of your valuation, whatever it is, into the buyer's equity? The vast majority of buyers want you to. Some of them require it. If you're going to transact with them, there's a minimum amount, call it 10, maybe 20% of the deal they want you to roll into their equity because they believe that it aligns you philosophically with their long-term strategic plan. If you're coming in, for example, saying that you're a big believer in their culture, their philosophy, you're all about growth, you want to be a part of the team for a long time, but your deal terms are 100% cash, you don't want to roll any equity. A lot of them are going to question, are they actually being realistic or truthful in their intent to be with us and grow as they say they are because they don't want any of our equity. So it's definitely a question that you need to come in with. I would say like a standard transaction we see today is somewhere around 80-20, 70-30, 80% cash, 70% cash to 20 to 30% equity. Was that?
Yeah, I would say, yeah, that's about right. Yeah.
And it's just to be clear, it's not a requirement that you take any equity. Just know that if you want it all cash, that will change the buyer pool a bit. You'll eliminate all the buyers who require you to take equity and I would also say sometimes it does affect the multiple. If they see a firm that's really interested in taking a large portion of equity, they may be a little more aggressive in price too. Okay, so that's the currency stack. The last thing I want to talk about before we get to multiples is terms. Okay, so there's a valuation. Then you're going to choose how you take the valuation in cash, deferred cash, or equity. Then there is the actual payout of the consideration, the total consideration. And so here we want to kind of clear up the form or the structure of the payments that you're going to receive. And I'll say there's roughly three types of payments. There is closing consideration. Closing consideration is the amount of cash or equity that you receive once you meet the buyer's closing requirements. Okay. And so just for today, let's say that let's say you did a 80-20 cash, 80 cash, 20% stock transaction, and their closing consideration was 70% of the proceeds. So let's say your valuation was $10 million in this phantom scenario here. So 8 million was going to be in cash, 2 million was going to be in equity. But of that $10 million, they're going to pay 70% of that at closing. Okay. So define closing for me. What typically happens to get to a closing?
The major thing would be going out to clients and getting their consent or their signatures on new paperwork, and you're at some minimum threshold. Usually it's at least 80% that you're getting, and sometimes 90, 95, depending on other terms that you're at, but that's the main thing. All employees have signed all documents, restrictive covenants that apply to them. And then you have clients on board.
Got it. Okay. So you're going to sign your purchase agreements and then you're going to transition your clients. Just mentioned the various ways of doing that. And you've got to cross a threshold and it's at least 80%, probably closer to 90 or 95%. And once you cross the threshold, the buyer is going to have a closing. We've already said the valuation was 10 million and they're going to pay 7 million of that. So, and you took 80% cash, 20% in equity of the total deal. So the closing payment is going to be $7 million.
Yeah.
But it's going to be comprised likely of all of the equity. So 2 million of equity, 20%
Yeah,
of
you want to get that equity right at the close. Sooner the
Absolutely.
better. Yeah.
and 5 million in cash. So of the 10 million, if 70% was released at closing, they're going to give you all the equity at closing and then the balance we paid in cash. So so 7 million would be paid, 70% of 10, 2 million of that would be all the equity that you got and 5 million in cash. So what happened to the 3 million? There's 3 million that didn't get paid. What is that called?
That's typically reserved for there's a lot of different words, but like deferred payment, retention payment, those types of words related to just needing to typically maintain either the revenue or the EBITDA that you had at the closing for a period of, call it 1 to 2 or 3 years, kind of ranges in there, usually landing around 12 to 18 months. You need to retain the business that you came in with, so not related to any growth, but just maintain what you had.
That was the point I wanted you to hit was it's predicated on keeping your existing business, however they're measuring that revenue, client, whatever assets. And so that 3 million that wasn't released at closing and it's all cash is going to be paid to you at the end of I'm going to call it a retention period. You could also be called a deferred cash payment, but it's a retention period post acquisition, a length of time that you just have to keep your existing clients and revenues. So let's say it's a year. So a year goes by, you've retained the EBITDA that the business was valued on. They're going to release that remaining $3 million or 30% at the retention payment calculation date. Okay, so we have closing payment, retention payment. The third type of payment we're going to call an earnout payment. Okay, so what would be an earnout and how does it distinguish from the retention payment?
So rather than maintaining the business that you had, it's about growth of the business above that starting point level. And usually it goes on for a bit longer than that retention-based payment. So maybe you have 2 or sometimes even 3 years where we're looking at the growth rate over that period of time, new clients, net new clients that are coming in and getting an extra valuation payment on that. Often it's at a lesser multiple than the initial valuation because the buyer is, you're partnered at that point in the growth. So you're sharing in that, like philosophically, that's why it's a little bit less typically. But the earnout would be based on growth of the business.
Yeah. And a lot of people, the reason why we're taking the time to differentiate these is a lot of people confuse, even the buyers we see confuse a retention payment with an earnout payment. And we want to make sure that the seller understands it's two different things. The retention is predicated on retaining your own business. The earnout is for post-acquisition growth. And buyers are all over the place in terms of how they structure this. I would agree it's usually 3 years or less in terms of the time. Most of the time, the buyers will put a cap on the earnout because they have to book this as a contingent potential liability on their financials, and so they're going to project a growth rate that, in theory, you're going to obtain over this time period, 1, 2, 3 years. And if you hit the growth hurdle, you're going to receive those earnout payments, which is additional valuation. In my scenario of a $10 million valuation, it would be on top of the 10 million that you received. And it's very meaningful. Like they can add 2, 3, 4 turns of the multiple higher than that initial valuation. But the thing we want to point out is when you combine the base valuation, that 10 million in my scenario, plus the earnout, they're going to express that in what's called a headline multiple. So often when you receive your LOI or you're talking to your buddy at the golf club who sold their business recently, or you read about an article in the CityWire, and they're throwing out these multiples. They are combining the multiple used on the base business, and they're combining the multiple of the earnout to complete what we call a headline multiple. So the thing, there's nothing wrong with that, but often we see buyers and sell side advisors, frankly, they will throw out these headline multiples that sound like incredible, right? But they don't tell you how that headline multiple is bifurcated between the earnout and the valuation of the current business. And so it can be misleading. It can be for example, if I gave you a 10x multiple on your current business and then call it a 7x additional on the earnout, that's a total of 17. So 17x would be the headline multiple. But sometimes when you pierce the veil or you look under the hood and you see what you have to do to hit that 7x, it's really not realistic. If you look at your growth rate historically and what they're projecting you're going to achieve, it could be double, triple like what you've done historically. So you have to ask yourself, how reasonable is that? Are they just putting this big fat headline number out there to entice me to sign the deal?
Right.
But it's not really realistic to obtain, and so we obviously at Alaris, we want you to have the best valuation absolutely possible, but we see offers all the time. Well, they'll come in and they'll tell us this big juicy number that they've received, and when we actually look at it, we have to kind of break it down for them and tell them like, okay, if you hit this incredibly aggressive growth number, which you've never hit in your entire this valuation is true, but we have to ask yourself, is that realistic? Are you going to have to sacrifice your client experience, or you have to work yourself to death? Or is it just possible at all? Okay. Okay. So now, what are some of the red flags that you see, impair valuation? What are some of the common things? Because it's not sufficient in our scenario that we've gotten to $1 million of revenue. We had 300,000 of expenses. We've adjusted that to 250. So now we have, what was it? 750 of EBOC. We're retaining 250 of owner's comp. So there's 500,000 of EBITDA. That's not enough to tell me what a multiple would be potentially applied, because there's all sorts of things that could go into it that could make the multiple higher or lower. So let's talk about some of the things that are impairments to the multiple.
Yeah. Well, we talked a little bit about the growth rate. So if that was on the lower end, like lower than the, national average, then that's going to be a focus. I would say also understanding how all of the client-facing advisors are set up. Are they servicing clients of the firm and have non-solicits in place, or are they more independent and we have some flight risk potential through the transaction? Let's see. I don't know. What would you say?
I would go out. So you mentioned growth rate. So we're gonna formally call that net new asset growth rate. So they're not going to look at just your growth rate. They're going to look at your net new asset growth rate, which was your growth rate after removing the impact of the stock market.
Yeah.
So if that, I would say a healthy 5-7% would be a really pretty good one. Like averages are around two.
Right.
Yeah, 2 to 3. So if you're negative on your growth rates, that will be an impairment to the evaluation. I would say things like your revenue mix. So we talked about that earlier. If you have too much non-recurring revenue, that's going to impair the valuation. Your client segmentation. So if your client age is if your average client age is north of 70, they're probably going to start looking at that as an aged client base, and that could cause some problems. The existence of Gen 2 advisors, period. If it's just you, they're inheriting your succession problem.
Right.
So it might not impair the valuation. It might impair the terms, like that retention scenario might push it out a little bit longer, so they protect themselves. I would say things like client concentration risk. If you have more than 10% of your revenue ascribed to any one individual client, that's a red flag. And again, it might not impair the valuation. It could impair the terms. Things like staff turnover. If you have a high staff turnover, historically, could be a red flag for them. So there's a whole host of things that go in there. Conversely, if all those things that we just went through are very strong, like if you have north of 5-7% net new asset growth rate, if your revenue mix is 90% plus recurring, if your average client age is 60 as opposed to north of 70, if you don't have any revenue tied to, more than 10% of your revenue tied to one client, all these things, the answer to these really determine on we always quote EBITDA multiples on a range, a low, mid, and high range. And so the answers to all these things go into where you're going to fall, low, end, or high. And then finally, I would say the cultural fit with the buyer. How strong of a fit are you with that buyer? If the buyer, that's why we believe so much in evaluating fit between the parties before we even get to math, because we know if the buyer falls in love with you, that will definitely move the needle on terms of their perception of value. Okay, so great talk. A lot of information here. So let's get to what everyone really wants to hear is
Yeah.
what is multiples?
Where are multiples for 2025?
Yeah. Okay, so I'll give you some ranges, and you tell me if you think I'm off. Now, keep in mind, folks, as we're talking here, we're only talking about the base valuation. We're not talking about the earnout. So we don't want you to hear our multiples and say, "Oh my gosh, Alaris is low in terms of the valuation." We're not talking about the earnouts because we don't know what the earnouts would be.
Right.
We're only talking about the base multiple. We're not talking about the headline number, which would include an earnout. So let's start at the $500,000 of EBITDA range. So I would say at $500,000 of EBITDA on the low end, you would probably be a 5 times to maybe a high of 7.
That's
You know,
fair. Yeah.
so 500,000, 5 to 7. If we get up to $1 million of EBITDA, I would say on the low end, you'd probably be at 7, perhaps to a high of 9. Okay.
10 million. Yeah.
Once we get to 2 million of EBITDA, I would say on a low end, you're probably going to be at 8.5, maybe 9, to a high of 10.5, 11, at 2
I was
million.
going to say like 11, 12. Yeah. Just depends. Yeah.
And then at 3 million of EBITDA, you're probably going to be at that 10 to 12, 10 to 13 times at 3 million of EBITDA. And north of 3 million, it just continues. They just keep bumping up 1 to 2 terms as you hit these EBITDA gates. So again, that's the base valuation, not the earnout. So the multiples could indeed be higher than that if you hit their growth targets. But that's sort of where we see 2025 shaking out. And again, I can't say this enough. The EBITDA multiple is important. It's not the most important thing. What is EBITDA is more important than what is the multiple.
Right.
Because I've seen offers that come in on the same business, and one is offering a 10x multiple, the other one is offering 8, and the 8x multiple financially is higher. Why is that? Well, the buyer who offered 10x allocated a bunch of costs into the P&L that reduced EBITDA.
Right.
So it was a higher multiple, but on a lower EBITDA number. So someone telling me what their EBITDA multiple is, I got to be honest, is frankly meaningless to me until I know what is EBITDA, what are the terms associated with it, what is the headline number. All of these things have to go into it before we know. So EBITDA multiples are great. That's why we saved them to the very, very last to talk about today, because there's a whole bunch of stuff that we needed to cover before we got to the actual multiple. So don't get hung up on the multiple. Let's get into the weeds of everything else, and then we'll apply the multiple once we know what EBITDA is and it's calculated properly. So
Perfect.
awesome show. So I can't wait for your interview. This is going to be fantastic.
Yeah. A little more into the weeds and keep the conversation going. Well, we'll break for that. Brooks Hamner, Mercer Capital. All right, awesome. Well, I'm so excited to be here with you today, Brooks. On our topic of valuations. I know everyone loves to hear about that. It's our first episode of the year. Great to have you on. It was really important to us. As you know, we've had a lot of buyers in the wealth management space on, but we thought for this topic, it would be great to have kind of that beacon of truth, Mercer Capital on. And I know you work so closely in the wealth management space too. Perfect. If you want to talk a little bit about Mercer Capital and what your team does, that'd be great.
Sure, Jacqueline, thanks for having me. Really appreciate it. Brief overview of Mercer Capital. We have no affiliation with Mercer Advisors. That's a common source, or you can or the consulting firm either. So I'm going to start off by saying that. But Mercer Capital is a business valuation firm. It was founded in 1982. What makes us a little bit unique is that we're a valuation firm that's organized into industry verticals. And so my industry focus is similar to your industry focus. It's probably how we know each other, but it's with ours is maybe slightly different, maybe a little bit broader, but ours is with investment management firms, and that is principally RIAs and wealth management firms like what Alaris usually works with. But we also work some with asset management firms, both traditional and alternative, and independent trust companies as well. And so we do valuations for a variety of purposes. Some in line with kind of what you do there for buy side and sell side work, but a lot of ours is more internal focused. So we're working on valuations for buy sell agreements or for the younger generation, next generation of management buying from, say, founding principals. We help establish a price for those transactions and work some on succession planning, co-consulting, things like that. We do some valuations for purchase price allocations, gift and estate tax compliance, fairness opinions, and a little bit of expert witness work around shareholder disputes or when a partner gets divorced. So our group is really solely focused on valuing investment management firms.
That's amazing. I love that. I have so many questions just came to mind just hearing you with that overview, and I definitely want to touch on valuation differences that you see between the internal transactions that may happen, like you were saying there, the team members buying in, that sort of thing, versus when we look externally. But before we get there, I think it would be great to cover the different, like, what are the valuation methodologies that your group primarily uses when doing this type of work, and maybe touching on some misconceptions, methodologies that you don't follow, but maybe that come up. Yeah.
Yeah, absolutely. A lot of the methodologies, and it's a great question, but a lot of the methodologies I think certainly you, and I think a lot of your viewers would recognize. I think the primary methodology we use and some other valuation firms and bankers in the industry, one you're probably very familiar with, and that is the DCF or discounted cash flow methodology. And there, we're just looking at trends in AUM, fees, revenue, operating expenses, profitability, usually over the last 5 years, and projecting that out into the future, usually over the next 5 years or so. Sometimes it's a 10-year model, sometimes it's a 3-year model, but any of it, we're trying to say, look at the trends in, client retention, ability to gain new business, net of lost accounts, where has its margin historically been, where are there potential opportunities for improvement, and forecasting that into the future. Then we build up what's known as a discount rate or a cost of capital to discount those cash flows and a terminal value at the end of the forecast period to the present. And that is the DCF indication of value. That's probably the primary, or at least the methodology we apply the most weight to typically in our analysis. But we also look at 2 other methodologies that are really under the market approach. And that is what you and your clients probably refer to as the COMPS method. We kind of break that onto 2 kind of categories. One is the guideline public company method. And all we're doing there is we're looking at publicly traded investment management firms and what are they trading at as a multiple of EBITDA or some sort of cash flow metric. And then we make some adjustments for the risk profile of our target company, our subject company, relative to and it's obviously there's a size differential, but we're making some adjustment to that multiple so that it better reflects the economics of our subject company. Then that's the guideline public company method. The guideline transaction method, or the M&A method, as you and your clients probably refer to it as, very similar, but there we're looking at transactions of wealth management firms, investment management firms, usually over the last 3 to 5 years, and what have those firms sold for as a multiple of EBITDA or some sort of cash flow metric. So very similar to guideline public company method, except there we're looking at actual acquisitions of investment management firms and RIAs, whereas the guideline public company method, we're looking at what the publicly traded investment management firms are trading at as a multiple of EBITDA or some cash flow metric. And so those are the 3 primary methodologies we use: the DCF or discounted cash flow methodology, the guideline public company method, and also the guideline transaction method. We generally stick to those 3. Sometimes if there's been transactions or an LOI pending, for the company we're valuing, we'll obviously have to take that into consideration. But if we're applying our own analysis, we're relying principally on those three methodologies. In terms of misconceptions, I know you and I have talked about this. You're frustrated by it. I'm frustrated by it. Your firm's written about it. Our firm's written about it. But a lot of that arises out of these. I think what you're alluding to is the rule of thumb measures to value these firms. And I know it sounds a little self-serving. I work for a valuation firm, and I'm telling you that you need to get a valuation for an M&A advisor in your case to help you with the sale, or at least understand the value of your business, as opposed to a rule of thumb multiple. But I think there's a lot of truth to that, because I know you've heard a lot of it. I've heard a lot of it. Maybe I'll start with the really bad rules of thumb metrics, the activity measures, and then work down to the better ones that still are problematic. But you know, for the longest time, we heard 2% of AUM, or 1 to 3%, or 1 to 4% of AUM. The percentage of AUM multiples are the most problematic. In addition to being, as you're aware, all these multiples, they vary with the subject company's risk profile, growth prospects. But in the case of the AUM multiple, it also varies with the firm's profit margin and the fee structure. So obviously, the AUM that yields a higher percentage of revenue is going to be more attractive to a prospective buyer than one that has, say, 30 or 40 basis points is all it's charging as a percentage of its AUM. So
It could be wildly different.
they can be extremely different. Yeah, and it may say, when you say, oh, your firm could be worth, your RA might be worth 1 to 4% of AUM, it doesn't sound like there's that big of a discrepancy, but 4% is 4 times 1%.
Yeah.
That's like me telling me your RIA is worth somewhere between 5 million and 20 million. That's not really
Right.
telling you anything.
Yeah.
So I think that and I think it does seem like the industry has acknowledged that. And I think you'd probably agree. We're starting to hear less and less of that AUM multiple, because it's just so problematic and it's generally not applicable. So
Mhm.
that's one, particularly problematic rule of thumb multiple. I think the next least attractive multiple is another one that we're hearing more and more about. That's the revenue multiple.
Yeah.
And I think it's better than AUM because it's not as dependent on a RIA's fee structure. But I think you would agree that the problem with the revenue multiples depends so much on the firm's profit margin.
Right.
So obviously, a firm that has a higher margin or yields more cash flow per dollar of revenue, that's going to fetch a higher price than a lower profitable, or higher the revenue multiple than a lower profit margin RIA. I mean, all that revenue multiple really is, if you do the math, the revenue multiple is the EBITDA multiple times the EBITDA margin. And so I'm sure you've seen it as well. We work with clients that have vastly different cost structures and therefore different margins. So to say 2 times, you hear this 2 times quite a bit. That's really only applicable if you say the applicable multiple is 10 times EBITDA. Well, that's really more applicable for a 20% margin. But we see RAs, and I'm sure you do as well. We see wealth management firms that have even below 10% margin, or sometimes they're just getting off the ground, they're unprofitable. And then some, depending on where they are and who their clients are, sometimes it's 30 to 40% EBITDA margin. So to compare, to apply that same revenue multiple to those firms with vastly different profit margins is very inappropriate. So we think the revenue multiple better than the AUM multiple, but still not particularly useful for valuation purposes. And that leaves us with, and again, it's what both our firms have talked about quite a bit, the EBITDA multiple. Again, better than revenue multiple, better than the AUM multiple. But an issue with that is, that multiple is very much dependent on a firm's growth prospects and its risk profile. And it's very rare that 2 firms have identical risk profiles and growth prospects. Also, calculating that multiple, I know y'all have written about this, but so you look at a list of transactions and it says, okay, the median is 10 times. Let's use that example again. But when you look at these deals, and as you and Alan have written about, what's the numerator and what's the denominator? Because so many of these deals, the numerator, it's 50 to 70% upfront, and some of that is also stock in the acquiring firm, which you have to value. But 50 to 70% is upfront, but the rest of that's paid in an earnout, and you don't know when that earnout. You don't know if it's going to be paid. And it also could take several years to get paid, 3 to 5 years, 2 to 4 years, whatever the case may be. So there's a present value aspect there. So that's the problem with the numerator. The denominator, just as problematic, because are we talking about reported LTM EBITDA? Are we talking about ongoing EBITDA? Are we talking about adjusted EBITDA,
Right.
forward EBITDA? And so I can tell you that reported EBITDA and forward or pro forma EBITDA can be drastically different.
Right.
As you are well aware,
Yeah.
what a firm recently reported and what a buyer thinks they can achieve in terms of EBITDA can be drastically different. So if you use those different measures of EBITDA, you get a drastically different multiple. So we think, again, admittedly it's self-serving, but we think rule of thumb measures can be very confusing. I understand why they exist. They're simple, and there's some market evidence to support them. But they can be, I think sometimes they do more harm than good because a lot of buyers and sellers get confused by them.
Can be really misleading. And the
Yeah.
part you were saying too about the earnouts, it's how much growth is needed to achieve those payments. Is it all retention based? Like, what are we talking about? Sometimes terms can be like interchangeable in the conversation, and so really boiling down what needs to be true for each payment to be made is so important. We do a lot of education around that with our clients.
Yeah, absolutely. And we look at when we value earnouts, or when sometimes our clients get these offers and they see that most of the consideration is in the form of an earnout. And I'm sure you all do this as well.
Mhm.
We have to educate them, say, look, here's the likelihood. There's really two. We're going to discount these future payments for two primary reasons. One, there's the time value of money. So obviously, the farther it out, the less value it is today in today's dollars. So there's a time value aspect. We're also looking at it kind of an expected value, or how likely is it realistically that you're going to get these payments. Sometimes it's just about client retention, and if they have high client retention, they'll probably get them. Sometimes it's about, and you've probably seen this as well, achieving a very high growth in AUM, or achieving a certain EBITDA margin that they've never achieved.
Right. Yes.
You have to discount that quite a bit because there's a high likelihood that those payments will not be made in full, or possibly even at all.
Hmm. Absolutely. Well, let's get into, okay, so when you're doing work for maybe just doing valuation work, not as part of an external like third party transaction, what does the valuation process look like with Mercer? Like, maybe things that folks need to have ready, the mindset that they need to be in, and why each item is important.
Sure. So
Yeah.
we would have initial conversation with the prospect about what the business is, what it is they need to be valued, the purpose, et cetera. And then assuming that we can help, we send them an engagement letter. And once they've hired us, we follow up with kind of what you've alluded to, what's an information request. And it's probably similar to like the the data rooms that you set up for deals. We usually, sometimes they email it to us, but usually more and more we're setting up data rooms for them to drop the information in. It's kind of easier for everybody. But the information we request, probably similar to what you request from clients. It may not be quite as onerous if there's not a an external deal contemplated, but to provide a credible valuation of the RIA, we still need quite a bit of information. But it's all information that should be readily available. So we're asking for internal financials. If they have any externally reviewed financials, audits, we want to see that, usually over the last 5 years. So they may not have an audit, but they should have internal financials. So you don't ask that, usually over 5 years. Tax returns for the business over the last 5 years. If they've made a budget or projections for the business, projections are going to be used. I talked about the DCF model earlier. Obviously, that's a critical input. Management has their own projections for the business. We'll use them. If not, we'll create our own. So we don't ever expect our clients to create documents that don't exist, that don't already exist. We'll do that for them, or we understand that they may not have everything we need. But we typically budget, projection, financials. We also like to ask about, AUM history. Now we can get their AUM history from their Form ADVs, but what we really focus on is we ask, how has the business's AUM changed, usually over the last 5 years? Is that change attributable to market conditions? There's always going to be fluctuations in fixed income and equity, but we also want to look at what is the business's, what we call kind of true organic growth. And that is, has the business developed more business net of lost accounts, or or clients that have terminated with the business or withdrawals from existing accounts, is the business generating AUM, generating new business above and beyond just what the market is doing? So we usually ask for a breakout of your AUM history. How much is attributable to, how much of those changes attributable to market conditions versus the firm's ability to bring in new AUM business and retain it net of lost accounts. So we usually ask for that detail as well. And usually the clients have that. We also ask, it's the operating agreements, LLC agreements, any equity comp agreements. And we do probably the most controversial thing we ask for, and I'm sure you do as well, is compensation.
Yeah.
And we don't ask for that because we're nosy, but oftentimes to value these businesses, they're usually owner operated. So usually the kind of the returns on investment and returns on labor get intertwined. So some RIA principals, I'm sure you've seen this a lot, they may not take a salary or bonus expense. They may not be taking any compensation expense. They're just taking it all out as a distribution.
Right.
Well, obviously a buyer is going to structure that differently. They're going to want to pay them some salary. I think you've noted in some of your materials, think of it as 20 to 25% of revenue or something like that. That's a good baseline assumption, I think. But in the case that they're truly not taking any compensation expense from the business, that needs to be restructured for valuation purposes. Firstly, sometimes we'll see where they're like Tennessee, my state, Tennessee used to have a hall tax on distributions. So we had a lot of clients that would simply bonus everything out, to maybe to minimize their distribution tax liability. Now that's no longer the case because we don't have the hall tax. But in that case, they would be reporting effectively no profitability, but we know it still has value. It's just that we would need to, a buyer of that business would obviously restructure the compensation, continue to compensate the principals, but at a more market level.
Right.
And so we always ask for owner officer comp. And then, operating agreements, LLC agreements, buy sell. If you had any LOIs recently, if you've had valuations before, any offers for the business. It sounds like a lot and it sounds pretty intimidating. And I think clients, when they initially see it, are a little taken aback by it, but it's usually all on one page. We understand that not all of it, they're not always going to have everything. But it is something and I'm sure you see it with clients when they're willing to sell, there's a fair amount of diligence on our clients and to gather all this information. And it's all critically important to the valuation because we're trying to simulate the thinking of a hypothetical investor in the business. You're working with actual buyers. So they're obviously going to be very focused on all this financial detail and making an offer. We're trying to simulate that in a valuation. So we're asking for all the relevant financial detail so we can make as credible evaluation as possible. So it's probably similar to what you're asking
Yeah,
for.
very, very similar.
Minus in depth,
Yeah.
but similar, I think.
When you were talking about the net new clients, like absent the market growth, I found that can be very counterintuitive to a seller, as wealth management, obviously portfolio management is part of the role, in addition to planning, and they sometimes when they view their value, or maybe they've articulated their value to clients as being more on the portfolio management side, to see that we are excluding that performance and really looking at the other organic growth, and unless the market growth is really below market or something, it's really not that's not really an attribute of commanding a higher valuation if the market performance of their strategies are outperforming, that sort of thing. It's kind of it's almost irrelevant. Yeah.
Right. And really it's more relevant for our asset manager clients, maybe when they're trying to have institutional clients and they're trying to beat a benchmark or whatever. That's their
True.
track record is very important. But for our your wealth management and RIA clients, that's not, it's more of a relationship of business, more financial planning, what's an appropriate asset allocation, given their risk and return parameters. So when we're, and again, what seems like thinking of a hypothetical investor in the business, but we're saying, where's the growth coming from? So sometimes when we see an RIA, let's just say they've gone from over the last 5 years, $1 billion to $1.2 billion, that seems like a decent amount of growth. When you think about if they're mostly invested in equities, the markets actually return quite a bit more than that over that time.
Right.
So it looks like their AUM revenue is growing, and it is, but the reality is in that case, they're probably actually losing clients due to age or maybe for competition. They probably actually lost some clients over that time. It's just the markets kind of mask that. And so you've been able to grow the business and profitability and revenue strictly because of what the market's done. So we try to strip those kind of apart because, and what we see in the marketplace, and I'm sure you have as well, those firms that have a demonstrated ability to gain new business, you're always going to have clients that retire or pass or whatever the case may be. But those clients that have a demonstrated ability to grow their AUM or their client base over time, they attract the most value in the marketplace typically. Whereas firms that are just kind of growing with the market, they tend to transact at a lower multiple. So that's a critical piece that we ask for. Not every client can actually produce that, but most RAs do that themselves because they want to know what new business they're bringing in net of lost accounts.
Mm-hmm. I mean, absolutely agree with that. Perfect. Well, maybe let's switch gears a bit. I love how you stepped through the valuation methodologies, how we're arriving at EBITDA. I'm curious how that's different in your work when you're doing a valuation for an internal transaction. What things are different that we should be thinking about to expect there?
Yeah, and I think, and you probably have more perspective on outside.
Right.
We do a fair amount of outside transaction work, but that's obviously more your wheelhouse. But we do more internal work since we're principally, a valuation firm. But sometimes when we're retained by clients, sometimes they're really just trying to figure out an ownership strategy or what to do. They haven't even figured out the internal versus the external route
Mm-hmm.
that conversation, and we'll have conversations about that, weighing the pros and cons. But a critical part of that is what's the different value. And so oftentimes, even before they've received an offer for the business and they haven't begun to market the firm, they're thinking about what could I get in an external sale versus if I transact internally with my current employees or the next generation of leadership.
Right.
And so we'll do that analysis. And unsurprisingly, the external value is a good deal higher, 25 to 35%, sometimes 50% or more, depending on, obviously who the relevant buyer is, but what kind of synergies they can realistically achieve, what kind of improvements in, say, fees or margin can they achieve. So we'll look at that. But there's typically a pretty significant delta between the external route that you probably work more with buyers and sellers with versus the internal route. And so that's largely attributable to a couple things. One, external buyer or synergistic buyer, strategic buyer, there's not a whole lot of synergies in these transactions. You're usually not coming in and reducing headcount.
Sure. Yeah. Very rare. Right.
It's a relationship business. And you all have talked about this on your prior podcast, but that's usually not, the buyers usually don't come in, and you see this in other industries. They come in and make significant reductions to headcount.
Right.
That's not typically true in this business because it's kind of like our business. It's maybe even more so for our eyes, but it's a relationship business. You're not going to fire a bunch of advisors that are bringing in, all this revenue. That just doesn't make sense. So there's usually no, headcount reductions contemplated. There may be some synergy, some cost savings that a buyer can realize that you couldn't achieve internally. But really what they're looking at is, can we find ways to, introduce them to a new target market? Can we help them with back office support? You talked about, is it integrators versus aggregators? The integrators can find ways to improve the business. They're not going to get in your day-to-day very often, but they can find ways to grow your AUM and revenue and sometimes help manage your expense base, or at least take some of those tasks off of your advisors or the employees to free them up to do other things. So a synergistic buyer is going to achieve better cash flow, better growth down the road. They're probably also going to have a lower cost of capital. These integrators or aggregator firms that we're all familiar with, that you've worked with, they're quite large, and they have access, unlike most RAs, they have access to debt financing at a lower cost of capital. So the discount rate that they're applying to those future cash flows is probably lower. And since value is inversely related to discount rates, that's also a further bump in the value. So when we look at it from an external perspective, we think there's certain improvements they can do towards growth and profitability. That's going to increase future cash flows. And those cash flows are going to be in all likelihood discounted at the lower rate. And all that together means that it's going to be a higher value than the internal valuation. the internal evaluation that we're working on, we're not obviously in that situation where next generation is buying from, the existing principals. They're not going to be able to realize any synergies. There's no contemplated synergies. The business is kind of what we call an as-is valuation. The firm, in all likelihood, will continue to operate the same way it has over the last 5 to 10 years into the future. So the growth will be similar. The margin will be similar. There's not going to be these enhancements that we would see with a strategic buyer, and also the cost of capital would be a little bit higher in that regard. You're
Right.
not going to have, it's going to be a smaller firm. You're not going to have access to debt financing in all likelihood. So the combination of all those factors, and in some cases, these are, minority interest investments in a closely held business. So we're applying a discount for lack of marketability or control. That's going to bring it down even more. So quite a bit, in some respects, even a little bit more analysis for an internal transaction, but it tends to be a good deal less than the external sale. And so from an economic perspective, we have to explain this to clients. Maybe we could refer some of them your way, but from an economic perspective, the external route is almost always going to be, it's going to be the higher number. The benefit, I think, to the internal methodology is that it's an owner-operated business. We're seeing more and more younger RA professionals asking about equity comp. They want skin in the game.
Right.
And selling internally to the people that are going to be probably managing your clients over the next 10, 15, when you leave the firm, they're probably going to be managing the business. And it makes sense for them to also have equity in the business. If you want to keep it independent, you want to keep it internal, you want to reward next generation of leadership. It also probably minimizes turnover relative to an external sale. If the next generation is not involved at all, so people could be upset by that.
Yeah,
So
definitely.
and leave. So there's pros and cons either way. But I think it is, it's important to note that the external route's going to be, almost always going to attract the most value. Internal route, maybe the benefit there is if the company stays independent, probably helps with retention and less turnover with that route.
Hmm. That makes sense. Yeah, we work with some buyers as well that if they don't see equity in the hands of next gen,
Yeah,
they're
that's
not
attractive.
really even interested in a partnership with them. So having that internal step as a kind of an interim step, um, and maybe continuing on that path, but maybe the consolidated group looking at an external transaction down the road, it also makes the business more valuable, seeing more shareholders at the start of the transaction and not leaving that succession planning all to the external buyer to sort out later.
Yeah, that's absolutely right. Sometimes we're doing a mix because they want to, you're absolutely right. I mean, especially if it is, wealth management industry is very much an aging industry. And a lot of the buyer looks at this and they see, the lead advisor, if he or she has 90 to 100% of the equity and 90 to 100% of the client relationships, that's just not as valuable as if another one that's transitioned a lot of that equity and a lot of those client relationships to other staff members. That's a more diverse ownership management group. That latter firm is almost always going to be transacting at a higher multiple. So in some respects, doing the internal route first and then the external route may be most valuable to the sellers. I think that's a fair point you make.
Long term. Perfect. Well, we've touched on a lot of the main drivers of commanding the highest valuation. Like we won't talk valuation numbers specifically, but when you think about kind of a market range of EBITDA multiples for, call it 500,000, a million, 2 million of EBITDA, those types of things, ranges are often talked about, and the firms that are commanding multiples on the higher end of the range or the lower end of the range, we've talked about a lot of the factors that go into that. It's growth, it's reliance on any one person, more of that lifestyle practice, or is the client base really served by a team of advisors, not as reliant on one person? What other factors would you say help sway it one way or the other over time that you're seeing?
Yeah, I think you've touched a lot of them. And when when we think about that EBITDA multiple, as we talked about earlier, it's really primarily a function of risk and growth, and it's inversely related to risk and directly proportional to growth. And so if we kind of isolate those two, let's talk about risk first. Generally speaking, and I've seen this on your, I was fooling around with the valuation calculator on your website, kind of consider this, and y'all need to take it off because it's taking business from us. But no, it's actually quite useful, and I'd agree with a lot of the inputs to it. First thing we're looking at the risk profile size, and it's on the multiples very much. So larger firms, usually more diverse client base, diverse management group. Those tend to usually the higher the size, the bigger the firm, the lower the risk profile, all else equal. So that's why we see billion to 2 billion AUM. Maybe that transacts at a turn or two higher multiple than say a 500 million, because they have the they have the scale, they have the size, a more diverse customer base, et cetera. So size critically important, and that's why I think that's a lot of the impetus behind the aggregator firms rolling up the RAs, because they know they can combine all these firms, and with the higher AUM base, they can attract, when they ultimately sell, they can usually attract a higher multiple. So size very important to risk. Generally, the larger the size, the higher the multiple. But we also look at, some of the things we talked about earlier, what you just mentioned. How dependent is this firm on one or two key individuals? If let's just take a $1 billion AUM firm. If you're looking at one and the lead principal has nearly all of the client relationships, he or she is in their 70s or 80s, this is, the business is very much dependent on that individual. A buyer's going to recognize that and discount it accordingly. Whereas a firm that we're seeing more and more shared responsibilities in terms of management, more of a team approach to managing client relationships, equity that's spread across a broad group of employees, that firm is going to be perceived as less risky to a prospective buyer and therefore transact at a higher multiple. A few other things we look at that you noted, we ask for information on client demographics in our information request. We don't ask for individual client names. They would just get that to us anyway. But what we're looking at there is, what percentage of your clients are we'll ask for what are your top by AUM or revenue, what are your top 5 client relationships? Not names, but we just want a client 1, client 2, client 3. So we're looking at client concentrations. So sometimes we'll see RAs that have, say, 20 to 30% that are of their AUM that's attributable to one family or a very large family. That's obviously, all else equal, pretty risky compared to one that's the highest is like 5 to 10% or something like that. Because if you lose that key client relationship, that could wipe out your entire margin or a substantial portion of your revenue. So we always ask for that. We're also looking at, older clientele that might not get that business, may not get the next generation's business. So younger, $1 million from say a 50-year-old client, probably going to be worth more than $1 million account for an 8-year-old client. Just don't know if you have the next generation's business. So we look at client demographics, that plays an important part in the risk profile, and therefore the multiple. So all that so customer dependencies, manager dependencies, and size really factor in on the risk side of that multiple. When we're talking about the growth aspect of, say, an EBITDA multiple, that's where we're focusing on, the changes in the AUM over time. Have they grown AUM just because the market's gone up, or do they have a demonstrated ability to gain new business, net of client withdrawals or distributions? And so that's why we ask for that. And typically what we see, and I'm sure it's consistent with what you see, we call it change the name due to market or marketing. Market, you can't control the market, obviously. That's going to go up and down. Hopefully over time it goes up, but you don't know in a given year. Yeah, you can't control it. Your marketing, you can't control. So there we're thinking about, does this firm have an ability to go out and gain new business on a year in, year out basis? Is that how they're really growing, or is that a huge factor in their growth history and their expectations moving forward? So that's really what we're focused on the growth side. And as you noted, it's on your website, as a result, because risk profile and growth prospects for each RA can be drastically different, the range of multiple is quite high. But a few things that you could think about and where your firm lies on that. On that spectrum, do you have a demonstrated history of growing AUM organically, not by the market, i.e., do you have, is your business dependent on one or two people, or is it spread across a number of advisors, and a few others, several people that effectively run the business and have equity ownership? Do you have client concentrations? What's the age of your book? All these things are relevant, and also the size of the firm. Obviously, all these things are relevant. It's why we ask for so much information from our clients, but all of these things are relevant in determining an appropriate EBITDA multiple. So what have I left out? I'm sure.
No, I love that. I was thinking when you were talking about the client demographics, and there's been firms and that we've been working with. Actually, one's still working with us right now, and they do have a higher average age client. I think high 70s, let's say, but they have been very thoughtful in requiring the kids and grandkids to attend client meetings. They have, maybe planning relationships with the 20, 30, 40-year-olds, and, not a full investment management client, but they're establishing those relationships early, and that really helps the overall story and the risk profile, like you're saying, that you wouldn't just know that from the numbers. But hearing, but we do some education around that to say, okay, yes, this is a fact. Your average client age is 77, let's call it, but you have some sort of contractual relationship with the next gen of over 50% of your households. That's really meaningful. The likelihood, from a buyer's perspective, the likelihood that assets would stay managed through the beneficiaries goes way up when you see that. And just different ways to look at it and the likelihood, and help build the case for perceiving less risk there, for sure.
Yeah, absolutely. And sometimes we'll request as a follow-up, can you just fill out relationships? So maybe it's just an Excel sometimes, and what's the relationship for each account, and by AUM. But the next column is, does the firm have a relationship with the next generation?
Mhm.
And we would look at, obviously those, to your point, those that do, they have a much higher chance of gaining that. So maybe they do have an older book, but if they have um, uh, that relationship with the next generation, then maybe their multiple doesn't get dinged, or maybe it's actually enhanced, because they will, in all likelihood, get the next generation's business down the road.
Perfect. I love it. Well, this was good. Thank you so much for the time, Brooks.
Thank you, Jacqueline.
Yeah, great to see you, and wishing you a great 2025. Yeah.
Yeah, you as well, and hopefully we can get you to return the favor, and you could be on one of our webinars or something. But really appreciate you all having me. Well, let me know next time
Love that. Yeah.
It's more likely that I'll be in Laguna Beach, or I'll try to find an excuse to get out there again. But again, thanks for having me. Really appreciate it.
Yeah, you got it. Awesome. Okay, well, that was a great interview. I loved hearing his perspective on, how we get to EBITDA, and especially around internal transactions versus external transactions. I thought that was really interesting insight that he brought to the table.
Yeah.
Well, we do have a quick mailbag if you think we have time.
Yeah, lay it on me.
Perfect. Okay. Let's see here. So Steve wrote in to say, I'm looking to get prepared to sell my business, and I have a few 1099 advisors on the team representing about 30% of my revenue. How should I be thinking about the benefit to a buyer and the valuation premium that this will command?
So we did a podcast recently with Nate Lenz at Concurrent, talking about this 1099 item. And so without going through that entirely, the thing that I would say is that if you have this guy, Steve, has 30% of his revenue that's tied to these 1099 advisors, he actually doesn't own that revenue.
Right. Not a benefit, really.
Yeah. So in trueness, in order for him to extract any value from that 30% of that revenue assigned to those 1099 advisors, they're going to have to participate in the transaction with him. Either transact with Steve in the scenario before they sell to a third-party buyer, or they participate in the actual valuation with him, which means they're going to have to contribute income
Yeah.
to EBITDA in order to participate in the valuation. So the bad news is, Steve, the 1099 advisors, why they today are offsetting your expenses, they contribute nothing to your valuation until you actually own. And when I say you, it could be collectively the 1099 advisors and you collectively own. The business owns the client relationships, and then business itself will transact with a third party. So you have some work to be done here to bind those clients that the 1099 advisors represent to the entity contractual. And so that has to be done before I would think you would want to sell. You might, I don't, they are a pretty significant part of your gross revenue. So probably a strong component of your net income. So I would think that's the thing that you should be focused on first before thinking about what a buyer would pay for it. Is you've got to solve this issue internally of getting these 1099 advisors to actually become W-2 advisors, on in the same entity with you.
Mm-hmm. I like it. Perfect. All right. Well, that's a wrap.
Awesome show. I
Yeah.
know valuations is a hot topic, and hopefully we did service to explaining how valuations are derived, what the levers are that you control, things that impair or improve your valuation, and then the all important EBITDA multiple. So awesome show.
Yeah. Awesome. All right. See you soon, Alan.
Hey, Jacqueline, talk to you.
Bye.